Well, hello everybody. This is Ken Winans from Winans Investments, and I hope you're not going too stir crazy in your homes, and you're certainly hoping you and your family are all doing well right now as we continue through this very unusual time in our nation's history, or for that matter, world history. I know it seems a little weird for me today to be doing a broadcast on April 15th. Usually we're worrying about taxes, and of course we have many other things going on. So I want to talk about what we've all witnessed over the last couple of weeks, and certainly what we see going forward for the rest of the year, and certainly pertaining to your portfolio. So in my opinion, we have witnessed this rally in the stock market has been a bear market rally. Very typical in bear markets. Prices move back very fast, but the volume levels are lower than during the corrections. And also, the leadership in these kind of markets is also suspect. It's led by utilities and healthcare stocks and consumer staple stories and certain technology companies. It's not as broad-based as you would hope. We used to call it a dead cat bounce, so it certainly feels like that, so to speak. But as we move forward, we are still expecting there to be some kind of a pullback in these prices. Hopefully you'll read Stephanie's report, and where it talks about how markets typically form double bottoms, where they have the initial drop, they come back up, they pull back again, and then that stabilizes things for the next run back up that's more stable. So I would, again, read Stephanie's report, but patience is required. I remember the 2002, 2003 bottoming in the dot-com bubble. Obviously, it took a long time. Even the 2008 crisis, even after the government stimulus plans were in place, it took many, many months for the market to finally hit bottom. So again, we have to be very careful about jumping in just because we think it's all over. So the good news is, if history is a guide, 2021 should be a good year for stocks, bonds, commodities, housing. That is very, very rare after these kind of situations that you have a second year that's like this. So just kind of keep that in mind. That's certainly what we're looking towards, is the path to financial recovery will hopefully kick off a good part next year. So looking at the Q1 performance, all the reports went out. If you haven't gotten them, you should be getting them soon. And we personally mailed them from this office to ensure that you had them. We also included your fourth quarter last year report so you can make comparisons. But anyway, there was a general sense of relief. Certainly they were losses, but they were not what I think a lot of people thought they were going to be. Our growth portfolios were down about 13%. I think that the benchmarks for the stock market were down something like 27%. And our bond portfolios were down about 10% when the proxies for those markets were probably down 12%. And when I say down in bonds, I'm talking about just prices, not projected income for the remainder of the year or what the bonds are worth when they come due. The bottom line is that I felt that the strategies we put in place have worked well. The raising of cash levels by selling off securities, using hedges in our stock portfolios, all seem to have worked very well. Going forward, we are right now looking for corporate earnings. They're out. The companies that we own are going to be reporting much of their earnings over the next 2 to 2.5 weeks. I mentioned earlier, I don't want to be committing new money until I actually see what's going on with these companies. To me, it would be a dreadful mistake to go out there and buy 10 stocks and have 7 of them get the heck knocked out of them because the earnings were bad. I really want to see what's going on there. We're also focusing right now a lot of the opportunities in bonds and preferred stocks in out-of-favor groups like oil and gas and retail. Granted, these are areas I would not want to necessarily buy stocks in, but to lend money to these companies by owning a corporate bond seems to make sense right now, especially when we're looking at some nice high yields on some 3 to 5 year paper. And many of you will probably see those in your portfolios over the next couple of weeks. So double bottom in stocks usually occur over a couple of months. What I would say is this: many of you asked, is it a good time to commit new money or money you might have parked in CDs or cash? Yes, I would. We're not going to put it to work tomorrow, but I would say that any money that's put into the accounts, we will find a good home for with some good investments over the next 4 to 6 weeks. So yes, I would agree with that kind of thing. Other things that you might want to think about. We all know the world has gotten kind of slowed and things have not worked well. We have checked with your custodians. They're still operating, but things are very slow. Opening new accounts, wire transfers. The fact that 1099s are still going out revised. They're clearly understaffed. Obviously, it's been a struggle for us and we're just a microcosm of what's going on in these bigger companies. Our staff is coming in at periodic times, and we're having rotation in who's in and who's out. So also I would bring up that in addition to what's going on with the custodians, realize that their web-based pricing on their websites, I also think is suspect when it comes to bonds and preferred stocks. I know I've discussed that as well, that, bonds and preferreds do not trade on an exchange in the same manner and the same liquidity as common stocks do. So I would just say, don't use your phone and your computer to evaluate your portfolio every day. I think it's bad investing discipline. I certainly don't do it, and I encourage you not to. I would also recommend, if you all know that July 15th is the new tax deadline for last year. But with that being said, many of you do not, or have never provided us with the names of your accountants and your attorneys. We're asking that you do so, whether it's a crisis or just a better way for us to communicate with your other advisors. Please send the information to Amy McGovern so we can put it in our files. It is confidential. And then I would just also say that as we wrap things up, the old phrase in the Great Depression, the only thing you had to fear was fear itself. I believe in that. I believe that, especially for you folks with kids, having to try to explain what's going on here, you have to find a way to operate. And as a money manager, our primary job is to make you money in good times and to protect you in bad times. And even with these tremendous handicaps that we've had with staffing, I felt that we've done a pretty good job of it. And certainly we're doing the best we can. I would say that we're committed to doing what we have to get things back on track as we clear out this crisis and can move forward. And I just hope you continue to be safe and healthy and try to keep your sanity. And I thank you for being a Winans client. And I will tell you that we're going to try to plan on having a post-crisis conference later this year at our offices, and we'll be able to talk more detail about the path to recovery. So thank you for being a client, and I wish you the best. Thank you.